Welcome back. This is lesson 4 of Forex Made Easy, a basic Forex video guide by Eazitrade Academy. So in the previous video, we covered the topic PIP and PIP value. And in this video, we'll be covering the topic lot sizes and leverage.
To start with, what is a lot size? In Forex trading, a lot refers to the standardized unit of measurement for trade size. So let's take a look at the breakdown explanation. 1, we have a standard lot, which in figure it's a whole number, and it represents 100,000 units of the base currency. If you are familiar with your quotes, a base currency is always at the left, while the quote currency is always at the right. So for example, if you are trading Euro USD, one standard lot will be 100,000 euros. Let's move on to number 2, which is a mini lot. A mini lot in figure is 0.1. This is 1/10 of a standard lot, or 10,000 units of the base currency. So if you are trading a mini lot of Euro USD, you are trading 10,000 euros. Third, micro lot, which is mostly used by beginners in Forex because of what? The minimal risk it has. This is 1/10 of mini lots, or 1,000 units of the base currency. Trading a micro lot of Euro USD means you are trading 1,000 euros. Now the last on the list, which is not commonly used, is called nano lot. This is 1/10 of a micro lot, or 100 units of the base currency. Trading a nano lot of Euro USD involves 100 euros. These lot sizes allow traders to control the amount of currency they trade and manage risk more effectively. Smaller lots, mini, micro, nano, are particularly useful for beginners or those with smaller trading accounts. Like I said earlier, smaller trading accounts are often amounts that are lesser than $500, even $1,000. That's the truth. But let's peg it at $500. So if your account size is less than $500, make do with micro and mini. If it's $200 below, make do with micro, and open minimum 2 positions if you are trading a major pair. But if you are trading instruments like gold with very high volatility and you're not yet very, very familiar with the market, you've not understood the market to an extent, maintain a single position. I just gave us a what? Risk management guide. So let's move on to looking at the pictorial diagram of lot sizes. As seen here, I made mention of their lots, how it's calculated in numbers. Standard lot is a whole number, that's 1. A mini lot, being 1/10 of a standard lot, is 0.1 or 0.10. Then a micro lot is 1/10 of a mini lot, 0.01, and nano, which is not commonly used, is 1/10 of a micro lot, which is 0.001. So we can see the amounts that they trade. If you are trading a major pair, you can see the total units of each lot on this diagram. So let's take a look at this other diagram, which also showcases the pip if peradventure you are trading a major pair, all right, which are Euro USD, GBP USD, USD JPY, USD CAD, and so on and so forth. If you are trading a standard lot, as seen here on this diagram, you will be making $10 per pip for a standard lot. If you are trading with mini and you enter with 0.1, you'll be making $1 per pip. While for a macro, you'll be making $0.1 per pip. And for nano, it will be $0.01 per pip. So moving forward, let's look at a broader explanation on this diagram. Let's read. Standard lot, which is one lot, 100,000 units of a currency. A standard lot represents $10, a point when using Euro USD as a base currency, while a mini lot represents $1, a point when using Euro USD as a base currency, and micro lots represents $0.01, a point when using Euro USD as a base currency. The point they are talking about is the pip mentioned in the previous diagram. I hope this is well understood. Now, the next on the lesson that we're about to talk about is leverage. And just so we know, we can't talk about leverage without talking about the following, starting from equity, margin, free margin, margin levels. So let's proceed. On the list, we have equity. If you're familiar with your trading interface on MT5 or MT4, I am sure that it might have been a question that has popped up if you've not done a research yet, or if you've not done your findings. Equity in Forex trading simply represents the total value of a trader's account. It is calculated by adding the current profit or loss of all open positions to the account balance. So, in a mathematical form, it is said equity equals to account balance plus unrealized profit or loss. So, for example, if your account balance is $1,000 and you have an open position that is currently $200 in profit, your equity would be $1,200. If, for instance, the market goes against you and you are on $200 loss, all you have to do is say $1,000 minus 200. That will be 800. That means your equity at the time, your unrealized, your balance rather, plus unrealized loss is $800. So that's what equity stands for. The next is margin. Margin is the amount of money required to open a position. It is a portion of your account's equity set aside and allocated as a deposit for your trade. The required margin depends on the size of your position and the leveraged use. So let's look at the example. For example, if you want to trade one standard lot, which is 100,000 units, right, of Euro USD, and the leverage is 1:100. Now note, leverage for brokers differs, it varies, and once we go into leverage, you will get to understand how it's being used and the risk involved. So I continue. The required margin would be 1% of the position size. The required margin. So as calculated in mathematical form, it is required margin equals to position size over leverage. So if your capital is 100,000, all right, a 1:100 would give you the opportunity to leverage on 100,000. So if you are entering the market with a standard lot, which is 1, that simply means you are leveraging on that 100,000 to trade with $1,000. So for every 1 pip, you will make $10. While for every 10 pip, you will make $100. Now note, you are trading with what? $1,000. That is the amount. But if you don't have the kind of amount, don't attempt to use a standard lot to trade. And before you can even attempt using a standard lot to trade, you must have gotten a broader knowledge about the markets to an extent, and possibly you must have good mentorship before you can attempt. I'm saying this for the sake of risk management. All right, so let's move further. The third is free margin. Free margin is the amount of equity in a trading account that is not tied up in current positions. It is available rather to open new positions or to withstand potential losses. Let's go further. Free margin equal equity minus used margin. For example, if your equity is $1,200 and the margin required for your open position is $1,000, your free margin would be $200. So that means as at the time you took that trade, you have a free margin left of $200 that will not be affected by the market. So for the sake of risk management, ensure that your stop loss is within that $1,000 that you used in entering the market. This is where a lot of traders makes mistake. They will leave their stop loss open. Thereby, if the trade goes against them, it will start affecting the free margin. If you've ever been liquidated, there's a part in the markets that once your free margin begins to show sign of being affected, it will go from blue to red. That is caused by poor risk management. In further videos, we will see practical example of that, or in subsequent videos. The last one is margin level. Margin level is the ratio of equity to used margin expressed as a percentage. It helps traders understand the health of their trading account and how much of their equity is being used to maintain their open position. This is calculated as margin level equal equity over used margin times 100, which is the leverage we talked about earlier. That's 1:100. For example, if your equity is $1,200 and your used margin is $1,000, your margin level would be 120%. So we can see free margin. The balance was what? Or the balance is $12. And while in the trade, what I am trading with at the moment is what? $5. That is what I'm risking. Entering with just this particular lot size, which is a micro lot. And I have a free margin of $7, which is not in the market. So we can read up on this repeatedly, looking at the practical implications of high margin level and low margin level and the risk involved, so that we can be able to apply proper risk management. Okay, so we're going to be looking at the actual topic, which is leverage. And like I said earlier, you can't talk about leverage without talking about margins, because it will not all go well when you finally want to know how to use leverage and you don't understand margin, equity, free margin, margin levels, which we've dealt with in our previous lessons. Leverage in Forex is a way for traders to borrow capital to gain a larger exposure to the FX markets or Forex markets. With a limited amount of capital, they can control a larger trade size. This could lead to bigger profits and losses, as they are based on the full value of the position. Leverage, which is the use of borrowed money to invest, is very common in Forex trading. By borrowing money from a broker, investors can trade larger positions in a currency. However, leverage is a double-edged sword, meaning it can also magnify losses, just like I explained earlier. So you must be in the level of a professional before you can start using higher leverage. So oftentimes, brokers have a default leverage for proper risk management. It is advised that you don't alter the leverage if you're not yet a professional trader. Leverage in Forex trading allows you to control a larger position with a smaller amount of money. For example, with 100:1 leverage, you can trade $100,000 with just $1,000 of your own money. This amplifies your profits but also your losses. If the market moves in your favor, you make more money, but if it moves against you, you can lose a lot more than your initial investment. It's essential to use leverage carefully and manage your risk properly. Please underline that last statement, very important. Now let's look at the pictorial explanation, the pictorial diagram of leverage. This is it. Your deposit with a leverage, you have higher buying power, as explained initially. So you can deposit $100, and if you use your leverage, you will be taking advantage of $10,000 in the market. All right, so that will be that for leverage.
With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. Alright, we'll see you in the next video where we'll be looking at risk management and position. Bye for now.